Good evening, and welcome to this Invest Talk webinar, Thinking Outside the Stocks. Your host is Steve Peasley, president of Klein Pavlis Peasley Financial, a registered investment advisor, and the author of Above Average Investing for the Average Investor. Steve invites you to ask questions by using the navigation buttons on your screen this evening, and he'll get to as many as possible during our uninterrupted hour. Again, welcome and enjoy the webinar. Here's Steve to get us underway.
Good evening, everybody. How you doing? Well, this is an interesting venue that we're going to try out here, and I've done webinars before, but haven't done one in a little while, so you'll have to bear with me if we have any problems. Tonight, we're going to talk about a number of things. Okay, we are at a very important course. If you're going to make money in the stock market, if you're going to do that, if that's your idea, you have to take some steps, and we're going to talk about that. I want to talk about what today's marketplace is like, why we are here, how we got here, quick, briefly. I'm not going to make it very elaborate, but how we got here. Then we're going to look at, well, what opportunities going forward. What's going to happen from this point on? Okay, and there's a lot of investment opportunities out there that look pretty good to me. Now, obviously, we'll look at, we know what the risks are. We're going to talk about that also. And we're going to try then to identify where you are in your current situation. What do you do? How can we do something about that? And the last point will be, plotting the course of actions. What are we going to do? How? Okay, how are you going to do it? What steps are you going to take? It's important that you do something about it, not just watch. Okay, now, what's happened in the market? We know what's happened. The market went from the top, from this very top to the very bottom. And if you'll remember right, it was a year ago last November 1st was the top, or last day of October in 2007. From that point on, the market went down, 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 consistently all the way to March 9th of this year. So there's a year and 4 months or plus. Okay, so the market was crushed, and there were some huge, what we'll call waterfall events in the stock prices during that period. We're going to talk about that a little bit more a little while later on here in the seminar. So the psychology of the market was crushed, was shattered, was just destroyed. Everybody was very negative. Okay, fear controlled everything. Very important. There's only two emotions in the stock market, fear and greed. They're the only ones that make any difference. They're the only two you need to pay attention to, fear and greed. So that's what happened in the market, because the market is a forward-looking instrument, and it saw the recession, and it saw the deepness of the recession, most of it anyways, before it actually happened, which is very normal. Remember, the market looks forward. So what's happening? The fundamentals really deteriorated, but now they're starting to improve. The technicals are starting to look better. That means charts are starting to look better. The psychology was that the market was so bad, the fear was so rampant. When everybody is fearful, that's when things start to change. And of course, what happened with the monetary system, why should the market change? Why should the economics change? Well, because of all the money the government's pouring out there. Look at the interest rates, how low they've driven it down. And look how much money, stimulus that they're spending to try to get the economy back on their feet. So that's what's happened, okay? Here's a graph. I'm showing you a graph of what's from 1929 to 2009, okay? How deep did we really fall? And how is that related to other times? Now you can see the deepest, of course, was 1929 to 1932, the Great Depression. Our market fell totally about 60%, totally. 60% from its high to low. But look at the other recessions you have. Notice that there's a number of them that got very close to 50%. The 1937, 1938, still in the Great Depression, to 2007, to 2009, that's ours. See it right there in the middle of the chart? I'll put my cursor there, right there. 2000, that's where we got. That was last year, but this did not, it went down 60%. You can see 50%, 60%. When of course this chart is not that up to date, but it went maximum 60%. 1973-74 was probably the most similar fall to the one we just had. Those two match up very well with each other. Match up very well, both in what happened, oil prices, housing, interest rates, banks going under, very similar to what we have here today. So we had a 60% fall. Our recession was deeper and longer than anything since 1932. Closest one to it was the 73-74 or the 1937-38, which I don't really count because that's still in the deep recession there. Now, what happens in the past? Well, when the president was elected, this is a little chart to show you what happens in the past. When a president was elected, look at Roosevelt, very top line. This is 100 days after his election. The market was up 75%. Remember, what was that? 1933. Very interesting. Look how much the market rallied in the middle of the Great Depression. So I don't want you to feel that we're not going to have this big rally. We're not going to have a big rally because we're in the middle of a deep recession. No, the stock markets don't necessarily coincide with the recession. Remember, the recession is a lagging indicator. The market is a forward-looking indicator. Okay? So take a look. Look at the presidents on the returns on the right side after 100 days of the election. What do you think of President Obama? Now, President Obama, the stock market when he was inaugurated was at 8,228. 100 days later is down about 200 points, 2 to 3% down, 2 to 3% down. So that's what happened with Obama. Now, what the market tells us, what does the history tell us? The market has different methods of contraction. It has different velocity of contraction. When it falls steeply over a short period of time, when it falls over a long period of time, you need to look at the various time frames of a very steep contraction. And I'm talking about 1 to 2 months of a very steep contraction. October was very similar, okay? Look at October of last year, how fast the market collapsed. Another one we had was the beginning of this year, January, February. Very steep collapse, okay? These are waterfall declines. And this is a list from 1950 of all the waterfall declines and then how long it took to recover from those waterfall declines. This is important because I'm going to show you what's happened recently. You'll see that the length and months of these types of very fast, steep falls, it takes about 1 to 2 months, sometimes half a month, 1 to 2 months. How long does it take to recover? Well, the average fall in a very steep, short decline is 2.4 months. The average time it recovers is 5.4 months from that very steep decline. Now let's look at something what was happened here. Look at what we have. This is from 1960 to 1981. You see the red circles are from where the event started, a very steep decline in a very short period of time, and then as it recovers, you see the next red circle moving up. Tells you can see them here, fall down to here, up to there. Notice where I'm putting my cursor. Here, down to there, back up to there. This one from here down to there, back up to there. You can see very, very fast, okay? So what happened now? What's happened now? Look at the waterfall event we've had this year. Go all the way over to here. Here's one from 2000, from the middle of the year all the way down to 2009. How long did it take us to recover from that? Well, we recovered this week. We recovered this week. Okay? But we recovered not all the way so far. Remember, it takes 4 to 5 months from the bottom. The bottom was March 9th, everybody. March 9th. It takes 4 to 5 months. We're only in June. So